This video will cover current events as of March 25th, 2020. I'll talk about fiscal policy a bit, even though that's not the domain of this course, which is a markets and institutions course. But it has an impact on monetary policy for sure. So we'll talk about monetary policy, obviously, in a bit more depth. Now, what's interesting is to compare this to the Great Recession, as we've been talking about forever. The Great Recession happened 10 years ago. People have been watching for over-leverage. They've been looking for stock market bubbles, real estate bubbles, commodity bubbles, you name it. People have been looking for it. We really haven't had anything significant. So nobody really thought that there was going to be a problem or financial problem coming up, or another Great Recession type environment. All that's changed pretty quickly. So what's interesting is how fiscal and monetary policy this time around are interacting. If you go back to the Great Recession, a couple of things happened. Fiscal policy, the politicians in Washington basically, they were not happy with what happened in the Great Recession and the liquidity crisis we had because they looked at the banks. They looked at even monetary policy, the Fed and commercial banks and Wall Street as being the source of the problem. And these guys, the politicians, had to bail out the banking system. I mean, that certainly was true. This time around, it's different. This time around, the source of the problem is not monetary policy. Interestingly, it's nothing to do with commercial banks. In fact, the banks are fairly strong at this time, reasonably well capitalized compared to what they were in the past. So now what's happening is you see a bit more coordination, a little more cooperation between the politicians and the banking system, which is good because now they're working together. So let's take a look at the fiscal policy component here. Remember what fiscal policy is all about. And we'll see this later in chapter 21. So I'm not expecting you to be able to model it like I'm modeling it here, but I'm going to show it to you quickly. So you see that it's coming up. It'll come up in a later chapter. Look, this is aggregate demand. And so aggregate demand, think of this for now, think of this as demand for every single asset or every single good or service, not asset, good or service in the whole country. And this is being inflation, and this is GDP, where GDP equals consumption plus investment plus government expenditures plus net exports. And what you see is a downward sloping demand curve. So when inflation is lower, and prices are lower, people are more likely to demand more goods and services. So think of it as that for now. And then we have a supply curve. And this is sometimes called the short run aggregate supply curve, which is what businesses supply goods and services. And so we have an equilibrium here somewhere. And so let's just say GDP for the year is $20 trillion. That's gross domestic product, right, which is the sum of consumption, investment, government expenditures, and net exports. You can think of these four components as the demand side, okay, as demand, and it's also being supplied by businesses. So you can't consume, invest, and so on without somebody supplying it. So this is where workers are a part of this supply, and firms are part of this supply. We think of this aggregate demand as being driven a lot by individuals. So here we are in an equilibrium. Well, what's happened with the crisis is, people are not allowed out of their houses. The demand curve has shrank and moved off to the left dramatically. And why is that? Well, that's because consumption, what you and I consume, is dropping off dramatically. And investment is dropping off. Remember, investment is for, you invest for the future, so to speak. And people aren't worried about the futures. They're not looking to invest for the future. They're just looking to survive at this point. So this is fallen off. So people aren't investing in property, plant, and equipment so much now. they're worried about what's going to happen. It's hard to figure out what exports minus imports are doing. I don't have a handle on that, in part because exports and imports depend on what the rest of the world is doing, and so that's likely to shrivel up a bit, but I don't have a good handle on it. So what I'm saying is aggregate demand curve shifted to the left. At the same time, people aren't going to work, and so the aggregate supply curve is moving off to the left. Now, all this boils down to, and you don't need an economics degree or finance degree, even go to a business school or college to know that, look, this is just a slowdown in economic activity. The amount of economic activity obviously shifting off to the left. It's because people are buying less and firms are producing less. So fiscal policy is all about trying to move both this aggregate supply and aggregate demand curve. And so what they're looking at is, for example, giving money. The government's going to give money to individuals up to $75,000 in income. They'll give them $1,200 per person, $2,400 for a couple, plus $500 for a child. And the government's looking to give billions to hospitals and billions to small businesses and billions to corporations, in part through, with the Treasury helping out with the help of the Fed. So as we'll see under monetary policy, the Fed is not going to actually make loans to individuals and to corporations because it just doesn't have the infrastructure. What it's going to do is it's going to give the money. It's going to give money and open up the credit facilities for banks to make it easy for banks, because banks have the networking system to deal with individuals and corporations, where the Fed just doesn't have that capacity to do that. It can deal with banks, but not your everyday corporation or individual. It's also involved with fiscal policy is payroll taxes. Payroll taxes are two components. Half of it falls on the shoulders of the individual, and half of it falls on the shoulder of the employer, having to pay for that. And so it looks like that payroll tax will be cut back significantly, and the payments will have to be forthcoming, but in well into the future. So what's this going to do? Well, by giving money to individuals, consumption will snap back a bit, right? And then the government's going to ramp up expenditures to help out various businesses and hospitals and so on. And so that's going to ramp up to try to bring this aggregate demand curve back. So remember, this aggregate demand curve, you slide down the curve if inflation is changing. Okay, we're just going to assume that inflation isn't changing. It's basically fixed at that level. And so which is why I have, basically a supply and an aggregate supply and aggregate demand curves shrinking back and the economy shrinking back with a price level relatively unchanged. In addition to the fiscal policy I just mentioned, it looks like unemployment benefits will be extended out. Again, that'll help with the consumption side of things. It'll give money into the pockets of people to spend and bring the economy back up. Okay? So now let's move over to the monetary policy side of things and see what's going on there. So the estimate is, so an estimate here is this was $2 trillion. That's a ballpark estimate. Some people are looking at this as $4 trillion, although the Fed basically said it was going to do, was unlimited what it could possibly do to help out in this financial crisis. But what's interesting from a monetary policy perspective is, look, if you rewind to the Great Recession, as we know, was caused by mortgage-backed securities bubble, right? A real estate bubble. There was a bit of a stock market bubble. There was excess leverage, right? And that all collapsed and caused an economic recession, a very deep recession. This time around, it's not the case. Wall Street, there was no bubble. There was no real excess leverage. The banks are in a really good position. And what's happening is we have a liquidity crisis problem that's likely to cause a solvency crisis. And let me explain here. So when this happened in the past, in 2007, 8, and 9, what we had was when this bubble popped, we had solvency issues were the main thing. And so there was questions of whether or not companies would go belly up or not. So they had lost a lot of money. Their equity was dropping off because they're highly leveraged. And when you're highly leveraged and things start working against you, you start making losses, and losses erodes your capital, and then you're insolvent. So what happened was insolvency of companies, or the prospect of insolvency, led to liquidity problems. And that's where things froze up. This time, it looks like it's a liquidity problem that, if it's not addressed, is going to cause a solvency problem. Because we don't really, at the beginning of this, we didn't have a solvency problem, but we started to get liquidity problems. So that's where the Fed comes in, and the Fed says, look, we're going to give unlimited amounts of money to commercial banks, and then the commercial banks can dole that money out to their clients as they need. They're the ones that know how to lend to individuals and corporations. So also, if you think about this in terms of term structure, the yield curve. So here's a picture of the yield curve. Here's yields, and here's maturity. And you have 1 month, 3 month, 3.0 month, 3 month, all the way up to 30 years. Maturities of treasuries. You see the interest rates, now that the Fed has cut interest rates all the way down to near zero, interest rates are here, and then they start coming up this way. You look at the graph all the way up to about 1.5%. And so what the Fed can do is the Fed, to help out liquidity, not only help out liquidity, but at the same time drive down these long-term rates, which aren't that high to begin with, but they can drive them down a bit. And they could do it in a couple of ways. One is they could have portfolio effects where they sell their short-term treasury bills and other securities and then buy long-term bonds, right? So that would kind of put upward pressure on this, but there's so much downward pressure at this end of the spectrum, that maturity spectrum, that it's not likely to have any impact. So they'll sell these securities and they'll buy the long-term securities and bring down long-term rates. Or the Fed could just go on and pile on to the banking system. It's just going to do operations where it's just going to buy securities, and it's going to issue reserves. And on commercial banks, we're going to see those reserves come on, right? And securities off the books for 100. Okay, that'll be in, you'll see this in chapter 17. So this is 21. This content we covered in previous lectures. This we've covered a bit in bits and pieces, but it's a big subject to chapter 7 of 17. What this means is, if you look at the market for overnight reserves, so this is the quantity of dollars, overnight reserves, like the reserve market, the Fed funds market is what I'm thinking here. So we have the quantity of reserves, we have the Fed funds rate, the effective or the actual market Fed funds rate. And as we'll see in chapter 18, there's a demand curve for those funds, and this is set at about 2.5%. So this is demand by banks that want to demand reserves to hold against their deposits and also to hold against liquidity. And so you can see that interest rates, these interest rates are really low. It corresponds to this part of the graph that I have here. And basically we have a supply curve here. So here's the supply curve for funds. And the supply curve is really far out there because we have a ton of excess reserves. This, by the way, is the interest rate on excess reserves. And so we're right here. This supply curve is going to shoot out and has been shooting out, but interest rates are going to stay relatively flat because we're basically hitting the zero lower bound, the ZLB. And that's why we're flat against the floor here and we can't get up. it's this supply curve of funds that are going out. Because look, when this supply curve moves out, it's because the Fed is adding reserves to the banking system. And under normal circumstances, if, for example, this supply curve was shriveled up and back in this area, you increase reserves, you would bring interest rates down. But we're on this flat part of the supply curve, the demand curve, which, while again, this is chapter 18. Okay? But we're on the flat part of the demand curve, so interest rates really in the short run are not changing. Remember, the reserve market is for very short-term lending, overnight lending to meet reserve requirements that the Fed sets for deposits, demand deposits. So now what I want to look at is, well, what exactly are these securities that the Fed is buying? What is it going to buy? Well, it announced that it was going to buy treasuries. Pretty standard move. But it also is going to buy mortgage-backed securities in the billions of mortgage-backed securities, just like it did in the Great Recession. And so you might ask, well, why focusing on mortgage-backed securities? Well, that'll lay off some pressure on the banking system itself, the standard commercial banking system, but it's also going to help with the shadow banks that are out there, because the shadow banks have a model that is a bit different than commercial banks. And here's the model. And this is by a guy named, by the way, Perry Merling. I think that's how you pronounce his name. He teaches at Columbia University, basically a money and banking course. And so he has a way of trying to summarize. So the shadow banking market is complex, it's diverse, and he tries to crunch it all down into a simple concept as best he can do into this simple analysis. It's a little bit heroic, but it's really, I think, useful to follow. So basically, shadow banking markets buy mortgage-backed securities, specifically residential mortgage-backed securities, and they fund it with money market type instruments on the liability. So they borrow in the money market. So money market mutual funds and stuff are buying this. So these guys are borrowing in the money market, which is very short-term interest rates, and they're funding it with mortgage-backed securities, and some of the mortgages underneath there are 30 years. And so there's liquidity problems associated with that, which is why the Fed is coming in and buying mortgage-backed securities to try to alleviate this, because they got to be able to sell these to be able to pay off these money market loans that they have, which are constantly coming due because they're very short term. These could be repos, these could be commercial paper type instruments that they're borrowing, and just other types of money, what we call money market instruments. Now, so this has a liquidity concern because they're borrowing short term and they're buying long-term investments. And so we learned about that in previous chapters. But I think what's interesting is that, this model is set up to hedge a lot of risks. And this is where the financial engineering stuff comes in. When you buy mortgage-backed securities, you're subject to interest rate risk because interest rates changes. It'll change the value of these bonds. And so these shadow banks employ interest rate swaps. Now, I shouldn't put it technically here. I should put the interest rate swap here because it's an off-balance sheet item that's hedging this risk. Okay, so then the shadow bank is hedged for interest rate risk using interest rate swaps. And that's just a financial derivative that offsets, literally, interest rate risk associated with floating versus fixed interest rates. And so here you can kind of think of these rates as being fixed in the short term and these floating in the long, in the short run. So these swaps, and they're a bit complex, we cover them in financial engineering, will help alleviate that interest rate problem. They also employ credit default swaps, which we talked a little bit about in the past, and that's the fact that there could be credit risk associated, defaults that are going on in this. Okay, this could be defaults from all the way down to the people who own mortgages. Think about it. People suddenly became unemployed. Now they don't have the money to pay back their mortgages, so they're going to default on their mortgages. Well, these credit default swaps that look at the credit risk, which is default risk associated with mortgage-backed securities. So they got that covered. But what they don't have covered, as I said before, is they don't have liquidity risk covered. And that's where the Fed comes in. It buys these mortgages up, makes a market in this, makes it liquid, so that then this process can continue to work. Okay, so the Fed's going to add the liquidity that the shadow banks need. And by the way, the regular commercial banks are also going to be helped out in that process. So to summarize, what's coming up is this is chapter 17, the money supply process. Some of it we've covered, but it's going to go much more extensively into more detail. Okay, that's going to be seen. Then chapter 18, you're going to see this graph on the Fed funds market, the reserve market, and that'll pop up 18. Chapter 19, which is on foreign currency and currency markets and exchange rates in the Fed. That's not a big player in this right now. There's not a lot happening, although we'll talk a little bit about liquidity swaps, currency liquidity swaps the Fed imposed and started up again. Well, it kind of never really left them. It has a facility, which means it's a program that just is in place and it stays in place. But they reiterated their commitment to buy or sell, or what we literally call swap currencies with other central banks. And we'll talk a little bit about that. But for the most part, it's not a big implication to what's going on in today's world in terms of fiscal and monetary policy. Then when we get chapter 20 will be a relatively light chapter. We'll look at the relationship between how money changes in the money supply. Percent change in the money supply leads to a percentage change in prices. And percentage change in prices, well, yeah, you got it. That's inflation. That's inflation here. And so in chapter 21, we're going to cover aggregate supply and aggregate demand and build a model that'll be fairly involved, and that'll be the end of the course when we cover the model, which is kind of a good place to end because we can address all the stuff that's been going, not all of it, but a lot of it, in terms of this model to help us understand what the government and the Fed is trying to do. That said, I spoke about this in terms of fiscal policy, moving this supply curve back, right? So this supply aggregate demand curve will move back if the Fed or if the government increases consumption by giving money to individuals and families. Government expenditures will shoot up. It'll try to push that aggregate demand curve. Unemployment insurance really won't move the aggregate supply curve, but helping out companies and lending money to companies will help move the aggregate supply curve to the right, okay, move in that direction. And a point that I wanted to make is that monetary policy, there's various dimensions of it. Monetary policy could end up moving along this demand curve, but monetary policy in and of itself, when it adds liquidity to the market, can help shift this demand curve. Because remember, this demand curve shifts, the aggregate demand curve shifts, whenever anything besides inflation has an impact on demand. Anything other than inflation is going to cause this curve to shift. So adding liquidity to the financial markets, it's going to cause the aggregate demand curve to shift out, at least in the short run. So that's current events for now, and it gives you a roadmap as to what we're going to be covering in future chapters. So as I speak, it's Monday evening on March 25th. Congress still hasn't gotten its act together and passed the bill. They're still wrangling over pieces and parts of it. And the stock markets, as you know, has been gyrating back and forth, up and down, quite excessively. And we kind of know why that is. It's one, there's a lot of uncertainty, and uncertainty hits the discount rate associated with cash flows. So remember, as I've said numerous times before, the value of any asset, including a stock, is the present value of its future cash flows. So you estimate and project those cash flows into the future, you discount them back. Well, those cash flows are highly uncertain. Nobody really knows the depth of the crisis, how long it'll last, how deep it'll go, and how it'll dig into and cut into earnings of various companies. It's probably going to dig deeply, so earnings will drop off significantly, which means the cash flow that a stock will throw off from dividends will drop because dividends come from earnings. So it's the interest rate variability, the discount factor. It's the fact that earnings in the future will be highly unknown as to where they'll be. All of those things are depressing stock prices, and so new information comes on board, and the market goes up a couple hundred points or it goes down a couple of hundred points. It's more than a couple of hundred. Sometimes it's a couple of thousand points up or down with new information as it comes through. So one thing we learned in finance is, and if you look at the stock market, is that volatility comes in clumps. So you just don't see volatility for one day and it spikes and it goes away. When you see volatility, it spikes. It can last a week. It can last 2 weeks. It can last a couple of months. But it's rarely a one-time spike up or down for a given day. So we're likely to continue to see a volatile stock market in because of these uncertainties.